Hi, so it's common practice to buy real estate and collect rent, but nobody teaches us how to own commercial real estate and still collect rent without ever owning a building. That's exactly what happens when you invest in REITs, real estate investment trusts. Now think of REITs as companies that own, operate, and finance real estate like malls, like warehouses, like apartment buildings, and even hospitals. When you buy a REIT, you're buying shares of the companies that own commercial real estate. In return, you earn a share of their rental income. So that's going to be paid to you as dividends. It's like becoming a landlord without the tenants, maintenance, or midnight phone calls. Now let's take an example. We all shop at Walmart, right? Well, did you know that Walmart don't own most of its buildings? Companies like Realty Income actually own the properties and lease them to Walmart. Realty Income is what I call Walmart's landlords. So when Walmart pays rent, the rent becomes income for Realty Income. And part of that income goes to you, the investor, as monthly dividends. Okay? Now by law, REITs are required to contribute 90% of their taxable income to shareholders. That's why investors love them. It gives you consistent and reliable income. It's like receiving rental income, but in the form of dividends, right? Now, here are examples of US REITs that I love, right? Number one is Realty Income. They own about 13,000 commercial properties. Now, what I like about them is that they pay dividends monthly. Okay. The second one there is VC Properties. They own major casinos and entertainment venues like Caesars and MGM. And then some Canadian REITs right there are Smart Centers. Okay, they own Walmart, part of Walmart as well, and then some other shopping centers across town. One of the largest REITs in Canada is the REIT called RioCan with ticker symbol REI.UN. Okay. Now let's talk returns. But before we go there, I made a separate video about dividend paying stocks in Canada. Click on the link in my bio to watch it. It's very educative, I promise you. Alright, so back to returns in REITs. If you invest 100,000 in REITs with a 5% annual yield, that's 5,000 in dividend per year. Okay, many investors choose to reinvest their dividends through a program called DRIP, Dividend Reinvestment Plan. Okay, it means your dividends automatically buy you more shares. Okay, compounding your income over time. Now you can do these easily on platforms like Wealthsimple and some other brokerage apps. So over 10 to 15 years, the DRIP, Dividend Reinvestment Plan, can turn consistent REIT income into serious retirement stream. Now, if you're in Canada, here's something important. REIT income from the US is taxable due to Canada-US tax treaty. Okay, for example, if you invest 10,000 in the US, in a US REIT like Vichy, you may lose about 15% in withholding tax on the dividend. So, US REITs are often best held in registered accounts like RRSP to minimize taxes. So, REITs give you the best part of real estate investing. It gives you regular income, it gives you capital appreciation, it gives you liquidity. You can sell the shares at any time, right? Now, this is without any debts, without maintenance, and without management headaches. That's why I call them the real estate for the 21st century investor, right? I've written an ebook that breaks down in details, including my top 5 REITs ETF in the US and Canada and how to buy them tax efficiently. Click the link in my bio or description to grab a copy now. And please share this video with a friend who loves real estate but doesn't know about REITs yet. Now remember, you don't need to own buildings to earn rent. You just need to own the right shares. Bye now.